And welcome to The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons. And today, it's about the re-rise of the Sunbelt. Talking all things Sunbelt, why it's slow, but what that outlook might look like. And I've got with me joining with me today to have one of the most active investors in the Sunbelt, David Moore, founder and managing partner at Knightvest, which has acquired more than 60,000 units across the Sunbelt and sold more than 26,000. So really excited to talk shop with David, get his take on the Sunbelt. And before we do that, I'll give you the latest on Sunbelt supply, demand, rents, and some thoughts on the outlook. Before we jump in, I want to give a shout out to our sponsor, Madera Residential. So please check them out, maderaresidential.com, Sunbelt investor, especially Texas. And I also want to give a big shout out and thank you to all of you who are listening. You helped get us into the top 200. We cracked the top 200 among investing themed podcasts on Apple last week, coming in at number 195. That's a pretty big number, but it's pretty cool to see us on the same list as the likes of Dave Ramsey and Odd Lots. You even have to scroll down quite a bit from those guys to find us. Certainly don't think the rent roll is going to be a threat to those big shows, but I do want to thank you for even getting us into that top 200 for our very niche rental housing podcast. And by the way, I didn't know about this until now, but apparently how you rate the show impacts our rankings on these things for Apple and Spotify and whatnot. So not just how long you listen, and thankfully many of you have been very engaged, but also the ratings you give. So thank you for all of you who've put on those 5-star ratings on Apple and Spotify and YouTube, et cetera. And if you feel so inclined and so inspired, I'd certainly be grateful to help us grow our ranking by rating us on your streaming platform of choice. So thank you in advance. And thank you for allowing me to pander for your votes. All right, so here's a chart. We kick off every episode talking about charts and data. You know, that's how I even got into this whole thing. So today's theme, the re-rise, the Sunbelt. I'm not calling it the rise. The Sunbelt's already risen, but it's had a moment of challenge, certainly. And let's talk about where it's at right now. If you can see the chart on the screen, you got to see a lot of dots and a lot of noise. This is as nerdy a chart as you can get. Nice little scatter plot chart. If not, you can't see it. I will talk you through it. What it shows is rent change versus supply change in 2024. Rent change on the y-axis going up and down, supply change on the x-axis going across. And what you see is a clear relationship between supply and rents. Where we're adding a lot of supply, rents are falling. You know, and that's the market right now. There's no denying it, no working around it, no talking around it. There is a ton of supply, particularly in the Sunbelt, and it's impacting rents. Rents are down nearly all across the Sunbelt where supply is going, led by rent cuts deeper than 6% right now in Austin, as well as Naples and Fort Myers. And by the way, it's on the one hand, it's kind of remarkable that rents aren't down even more, given these 50-year high supply numbers. Rents are falling in really low single digits across most of the Sunbelt in the mountain region where the supply is going. But on the other hand, we know it's all about supply because, number one, rents are still growing where supply is not going, headlined by the Midwest and Mid-Atlantic and Northeast. All those little dots in the top left, that's showing you markets that are still seeing rent growth. And we see 3, 4, 5, 6% rent growth in a lot of those markets, but you also see 2.5% to 3% or less. Really, most of these are 1% to 2% supply expansion, which is really nothing. I mean, some of these markets are losing just as many units to obsolescence, just age, as they are adding. And so if you're anywhere, less than 2.5%, that's just not a lot of supply. And those are the places that are still raising rent. So it's all about supply. And number two, we also know it's all about supply because demand's been there. So here's another chart showing the Sunbelt winning an outsized share of the demand, more than 400 units absorbed across the Sunbelt and the mountain regions in 2024. That was nearly 2/3 of all net demand last year. So demand's there, not a demand issue. And you can't talk about high supply without talking about high demand. If you ever want to detect bias against the Sunbelt from Sun folks who just don't like it, just listen to talk about supply, 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 and not talk just as much about demand, demand, demand. Because supply will come in waves, but demand tends to be more structural for the markets that are fundamentally solid. Now, one of those demand drivers is population growth. Here are the top 15 over the last 5 years. All of the top 15 MSAs are in the Sunbelt. That's where people have been going. That's where people will probably continue to go. Here's the 5-year population growth by, and this is percentage growth, so it's adjusted for size, among metro areas at least 1 million in population. And all 15 are in the Sunbelt, led by Austin, Raleigh, Jacksonville, Dallas, San Antonio, Charlotte, Orlando, Fort Worth, Tampa, Phoenix, Houston, all 6% or higher. Nashville just below that. Then Las Vegas, Oklahoma City, and Atlanta. So OKC, a little bit of surprise in there. And now let's look at the next 5 years. Obviously, the past is the past. The future is what everyone's banking on. And this is a forecast from Oxford Economics. They're predicting that the trends are pretty much going to remain as they are. The top 15 metro areas for forecast population growth, 14 are in the Sunbelt. Seattle is the only exception in the number 13 spot. And Oxford is especially bullish on Austin, Raleigh, Houston, Orlando, Charlotte, Dallas, and Phoenix, as well as Jacksonville, all more than 6.5% population growth in their forecast. So, one of the things I always look at with demand is that, supply you can predict just, starts to push forward. With demand, the question I always ask is, okay, what would change a market that's already seeing good demand, good job growth, population growth, et cetera, migration? Why would it revert back? And in most cases, those numbers could fluctuate a little bit, but the leaders remain the leaders. And so these are the places that are still expected to retain that demand advantage. Now, part of that demand story comes from affordability. So I have another chart here showing you that this is the average, the discount to rent in an average Sunbelt and Mountain market versus an average major coastal metro area for apartment rents as of December. And yeah, people talk about how things have gotten less affordable. That's true of almost everything. Everything's more expensive than it was prior to COVID. But most of the Sunbelt is still dramatically cheaper than the coast. And that's an advantage when it comes to migration and population growth. Compared to average rents in major coastal markets, rents are around 50 to 60% cheaper still in nearly every Sunbelt MSA, with the exception of South Florida, which is around 20 to 25% cheaper. So that's an affordability advantage. It's not going to go away anytime soon. That's going to take decades, not years. And that contributes to the demand magnet we see in the Sunbelt. So again, demand tailwinds look favorable. Barring a big drop in the economy, of course, a black swan event, there's always something that can happen. But the big picture, demand tailwinds look pretty strong. At the same time, we see supply, as I've talked about a lot in the past, and everybody knows this at this point, supply has fallen off the cliff. So here's 2024 starts compared to the cycle peaks, down everywhere across the Sunbelt and most of the rest of the country too, for that matter. Apartment starts are down 70+% in San Antonio, Denver, Jacksonville, Salt Lake City, Raleigh, Durham, Houston, and Fort Lauderdale. Also down more than 50% in a bunch of other places, and I'll highlight a few: Austin, Atlanta, Phoenix, Dallas, Nashville, among others. So these drops and starts are so big, they point to not only moderating supply. People talk about slowing supply. It's always worth remembering, it's not just moderating supply. Like, these numbers are plunging below normal supply levels, below the pre-COVID norms of 2017, 2019 range that we saw, at least according to the forecast that we're pulling in. Here's a chart for those able to see it. It shows, and I posted this on LinkedIn this week as well. It shows when will the trailing 12-month supply levels drop below those pre-COVID norms by metro area. So by late this year in 2025, we're going to get at least slightly below normal supply, and again, normal being 2017 and 2019 averages, in Nashville, Denver, San Antonio, Dallas, and Houston. By 26, we'll get there across most of the rest of the Sunbelt and most of the rest of the country, for that matter. Austin is showing as the only exception here, but I wouldn't be surprised if it slips into 2026 too, as this all plays out. And by the way, for those able to see this chart, it also shows the supply peak as a percentage of stock. So the supply expansion rate, Austin way above the rest of the country among major markets. The only one in double digits at peak expansion rate, more than 10%. And that is a good reminder, once again, that Austin is not and should never be a proxy for the entire Sunbelt region. In fact, the only other markets even above 8% are Charlotte and Raleigh. Then in terms of peak expansion rates, it's followed by Nashville, Phoenix, Salt Lake City, and Jacksonville. And here's a good trivia question for you. The next one is actually Denver. So Denver's above places like San Antonio, Dallas, Tampa, Atlanta, Orlando. So Denver's been building like crazy. That's one's actually slowed down a little bit in the last part of 2024, in part because of all that supply. All right, so what does all this mean for the outlook? Well, let's look first to the past and to the present before we look at the future. And this chart shows rent growth in major Sunbelt markets versus major coastal markets. So aggregate of major Sunbelt versus major coastal markets, year over year, effective asking rent growth going back to 2012. Now, right now, you can see that the Sunbelt is underperforming. Effective asking rents are up. Rents are down 2.2% for the major Sunbelt markets versus up 1.6% on the coast. That's being lifted by the East Coast in particular. But that followed a decade of Sunbelt outperformance. Now, obviously, everybody remembers what happened during COVID in 2020 and 2021, where the Sunbelt, way outperformed the coast. But even prior to that, we saw a similar pattern to a more moderate degree. And in that period, from 2013 to 2019, the Sunbelt saw average annual effective rent growth of 3.9%. That was 100 bips higher than the average coastal market. Now, and by the way, some people thought the Sunbelt had a lot of supply back then, but it was really a mistake of looking at who has the most supply versus who actually has a lot of supply. Yeah, Sunbelt markets were leaders, but it really wasn't that much in the grand scheme of things, especially relative to demand. So having more supply doesn't mean it's a lot. It just means you have more than somebody else. But it doesn't mean it's going to materially impact the market if you can't keep supply up with demand. So I think you can make a case. Nothing's ever a given, but I think you can make an argument that we could revert to something like this chart, looking at the pre-COVID trend as supply tapers off here over the next few years. If supply drops and demand remains solidly healthy, you could make the case that the Sunbelt will be an outperformer again. And of course, again, there's no guarantee this plays out. But if it does, that trend could last a while, just like it did in the 2010s decade, because it's highly unlikely we're going to see a supply resurgence anywhere near the levels that we're seeing right now, for all the various reasons I've touched on in prior podcasts. It's just a much tougher environment to get new starts going at any real scale. All right, so there you have it. There is a bull case for the Sunbelt outlook. There's still some real challenges to work through. We're still negative rents in most of these major Sunbelt markets. Tampa is the first one to finally go positive, but there's still a lot to work through. So this is really a look going out, to years 2, 3, and beyond. Although in some cases, I think we will see better performance here in 2025 as well. So I don't want to downplay the challenges that exist. Those are real. We're seeing a real impact from this volume of supply. But I tell people all the time, we're finally seeing the impact of what happens when you really, truly build a lot of supply. Normal levels of supply are just not a lot relative to demand that these markets tend to see. And so again, that's why I like to look at that pre-COVID era for maybe a baseline of what the outlook might look like. And by the way, the coastal markets in the grand scheme of things did pretty well back then too. So it's not really a knock on the coast so much as a comparison point for how the Sunbelt could potentially look in a lower supply market where demand remains strong. All right, so that's just one guy's take. We're going to hear from David Moore of Knightvest later on and get his take too. Certainly, Knightvest is remaining bullish on the Sunbelt, and as does Madera Residential and many other companies as well. So definitely not a secret, and they're using arguments like some of the things that I've shared with you here. Next up, rental housing trivia. All right, today's trivia question. We've been talking a lot about big Sunbelt markets, so let's talk about some small ones. And the question today is, among smaller Sunbelt markets, which one did not build at least 12,000 apartment units in total between 2021 and 2024? Let me give you 5 choices here. So if this is a process elimination, which one does not belong with the rest? A, Charleston, South Carolina. B, Greenville, South Carolina. C, Huntsville, Alabama. D, Sarasota, Florida. And E, Savannah, Georgia. All right, so which one did not build at least 12,000 units. And by the way, I'm just going to give them one away here. If anybody picks Huntsville, Alabama, you've probably not been paying too much attention because that market has been building like crazy. So I'll let you go ahead and eliminate that one from the options. Next up in the news. All right, so this week we have just one headline to cover. It comes from the Wall Street Journal. The headline is, and actually this is a column piece, and it says, the U.S. has more fancy apartments than it is able to fill. And then the subheadline, real estate developers have built a glut of high-end properties instead of badly needed affordable housing. All right, so if you followed this podcast and my postings, you know that an article like this is going to get my attention because it's based on a couple premises that we know are just wrong. The first premise is that the U.S. has more quote unquote luxury new apartments than we can fill. That's a misleading statement, especially without any kind of time frame attached to it. Second statement here, that developers are building Class A at great expense to affordable, or to the detriment of affordable, or choosing one versus the other. That's also a deeply misleading statement that only somebody who is not familiar with housing construction could possibly make. So real quickly, on the demand side, the columnist failed to note that apartment demand in 2024 was very robust, as I've covered here, kind of be the second best year on record in all likelihood. And nearly all of it went to so-called luxury apartments. In fact, I thought it was interesting and a little bit discouraging is the columnist of this piece got much of her data from CoStar's recent press release on Q4 data, but just ignored the demand story in the same press release that undermines the narrative of the article. The press release that CoStar had that she cited talks a lot about the resurgence of demand. And CoStar has written a lot about how in particular that demand is going where? Well, to these newer, higher end, more expensive properties. So there is a lot of demand for this stuff. Now, does it keep up with supply in the short term? It hasn't. No, that's fair. But you can't just pretend like that demand is not there. These units are eventually going to fill up, and they've been leasing probably faster than most people, myself included, expected them to lease up in most of these markets. And then on the other issue is the contention around affordable housing. It's too much to get into here in too much depth, but a couple quick things. Given high construction costs for housing, most big A, capital A affordable housing only gets built with tax credits or other subsidies. So there's a finite supply of those. Otherwise, these deals don't just pencil out. So it's not just about thinner profit margins. It's just like these just don't work. They're not. You can't build them. And so if this Class A apartment supply, which is what pencils out, if it doesn't get built, it wouldn't be replaced with affordable. These units just wouldn't get built at all. But also there's the filtering phenomenon. And that gets entirely ignored in this article. One of the more well-researched topics on housing. I've talked about this a lot in this podcast in the past. I'm not going to drone on too much. But again, there's a clear academic consensus around the fact that we build housing of any type, even luxury, there's a downstream impact on housing affordability and availability, even at the lower rent levels. So a more accurate framing of this article would be that luxury lease-up velocity is slow due to the volume of supply out there, but thank goodness for it because it's putting downward pressure on rents. It's opening up more availability and at the lower price points as higher income households move out of the more moderate price units up into the new supply. But construction is also plunging right now, and eventually all these new units are going to get leased up. So we'll be talking about undersupply again before you know it. All right, there you go. There's your quick rewrite. Next up, good question. All right, so all the data releases, one of the things I always get asked about, and I got this question again recently, is why do we see material differences in supply and demand numbers from different data providers? And this is a good question. And certainly it would take a lot more time to kind of break down the differences between each data provider. But the short of it is that they all have different methodologies. You may look at something as simple as, hey, what's the national number? Well, different data providers define national differently. Some will call it top 100 or top 150 MSAs or top 89. They each have a different threshold. Some are truly across the country. And even look at supply. Some will count, units that were, let's say, a 300 unit property, 100 units were completed in 23, 200 units completed in 2024. Are you counting phasing of, the same building, not like two different like entire properties that end up being combined, but we have eight building garden property. If two of them complete in 23, some might count that as 23 completion. Some may wait for the whole property to complete in 24 before they count it. And sometimes too, supply is tough to track. Sometimes some provider catches one and misses another. And so you're going to see slight differences in some of that data. And the same thing with rent. You're going to see slight differences depending on how people calculate rent. Is it same store? Is it including lease ups? And a lot of other factors that you can look at. Does it include concessions and not concessions? It goes on down the list. And so you're going to see differences. Now, the big thing, I think, when you look at the major data providers, you're generally going to see a pretty broadly similar trends. So take the demand story, for instance. RealPage reported demand was in the mid 600,000 range. CoStar said it was in the, I believe, upper 500,000 unit range. So there's a big difference there. But either way, you're talking about some massive demand or absorption numbers. And so the broad trend is very similar, regardless of which data provider you use. I think either one is, I believe, still going to be the second best year in recent history. So you're going to see differences like that, but the broader storylines are going to be, by and large, pretty similar. All right, back to rental housing trivia. And again, today's question was, among smaller Sunbelt markets, which one did not build at least 12,000 apartment units between 21 and 2024? We gave you 5 choices: Charleston, Greenville, Huntsville, Sarasota, and Savannah. I already told you Huntsville wasn't it. So the correct answer is Savannah. So there's been a lot of building in these smaller markets too, but Savannah only built just over 6,000 units over that time frame. Still a good chunk, but it's less than half the total of the others. And by the way, Savannah's a cool city, and if you've not been there, I'd recommend it for a weekend visit if you've never been. And that's going to take us into the interview. And so now I'll have the pleasure of welcoming in the founder and CEO of Knightvest, a very active investor in the Sunbelt, David Moore. All right, now into the interview portion of today's podcast, and I am thrilled to welcome in the CEO of Knightvest and a board member with Apartment Life. David, thank you so much for being here.
Thanks for having me.
So, David, you shared your story, kind of the background of Knightvest on one of everyone's favorite podcasts, The Fort with Chris Powers. So I won't ask you to retell that whole story. But one of the things I love about your story about starting Knightvest is you started by investing in, I think we call it a Class B property in a tough part of town. And you were working on site every day, managing the property, leasing units, turning units, trying to collect rent. And I'm not sure how many of your peers, apartment executives with 10, 20,000 plus units have had that type of experience. And so I'm really curious to ask you, how did that experience on site at a tough property really shape your strategy and your leadership of the company as it grew?
Yeah, that's a good question. Yeah. So when we started, it was literally on the ground. We did the leasing, we did the management, we did really every aspect of the business. And I think to this day, and since we've bought now 60,000 units, which is just mind blowing, because when we started, it was really just, how do we make a living? How do we put food on the table? How do we pay a mortgage? And we didn't have a job. So really we didn't have anything else to do. So we went down there literally every day. We knew all the residents. We collected rent. We went to eviction court. I've personally been to eviction court many times. We carried the leasing phone. So we showed apartments. Well, we were never good at the maintenance. So we tried to, I think one time we tried to hang a front door. Someone had kicked it in. We tried to hang it. And we soon realized that skill set is well beyond us. But I think even to this day, what that experience brought is just how hands-on you need to be in this business. And it really is an operating business. It's not, when someone asks me what I do for a living, I never say I'm in the real estate business, because I'm really not. These are operating businesses. These are people's homes. These are, you have to be very, very involved. So even to this day, I think we probably have 10 or 12 asset managers. The one full week in January, we make all the asset managers work on site.
Wow.
So even to this day, we work on site, and I want them to understand really what it takes to manage these properties. How do you deal with residents? How do you we say we have, we want customer satisfaction. How do we really deliver that? How do we work on the work orders? How do we talk to people when they're coming in? How do we show apartments? And I think that's really important, because I think a lot of people, most people are really good with finance or really good with Excel. They understand the number side. But what we really want is also to pair the number side with the people side. And we think that ends up being in creating a better business.
No, that's a great point. I mean, at the end of the day, it's a people business, the staff and the residents. And I like how you say these people's homes.
Right.
So I'm sure that experience working with people living in these homes gave you maybe put that into much more real. All right, so let's fast forward to the market today. It's been a few years since that experience.
Yes.
We're obviously seeing great demand, especially in your markets across the Sunbelt, just in terms of macro demand at least. Obviously, a lot of supply as well, so that's pushed up vacancy, led to some rent cuts. Mostly, I think, fairly modest, but there's still cuts, and that supply is peaking now. It drops off significantly by later this year, as you know. So what are you seeing on the ground in real time? Are you seeing an inflection point yet in terms of demand catching up to supply? Is it getting better yet for operators?
I think it's getting better. I mean, it's obviously market by market. So we're in this Sunbelt markets. We're in 8 markets, the major markets of Texas, Phoenix, Carolinas, and then Orlando.
Yeah.
So know enough about those markets to be dangerous. But I think the markets are getting better. Occupancy is stabilizing. Our portfolio is 93% occupied, which we feel good about. Rent growth is still pretty flat in most markets.
Yes.
And then the 2 markets that we are in, the 2 out of our 8 that we are in that's probably lagging the others is Austin, which has been well documented.
Yeah, absolutely.
There is a ton of new supply. There's just no hiding from it. And we were on site a couple months ago and talking to the manager about how it's going. It's property that we've owned for about 18 months, and she said that we're competing with a new build that is offering 3 months free.
Yeah.
And that is, I literally had nothing for it. I just said that is tough competition.
Yeah.
That is tough competition. But I would say the other markets that we're in, the major markets of Texas, the Carolinas, and in Orlando, major markets minus Austin, we are seeing an uptick.
Good.
It's still very, very, very relatively flat, but I would say that the rent decreases have stopped.
That's good. What about Phoenix? Is that one still kind of tough sledding as well?
Phoenix is tough.
Yeah.
Phoenix is tough. There's a lot of new supply. And maybe it's where we have properties. We have a number of properties in downtown Phoenix. And downtown Phoenix, I'm out there and I just look at cranes.
Yeah.
But Phoenix, I think Phoenix will come back, faster than Austin. I think Austin will be, of the markets we're in, the one that will take the longest.
They're probably larger markets, but that's probably the one for the whole country that'll take the longest.
Right.
So, and by the way, I just did a quick aside, David. I think it's interesting is nationally there's so much conversation around affordability and rents and how to tame rent inflation, and you look at what's happening right now in a place like Austin. There's so much supply. It's like from a policy perspective, I know NMHC and others are all over this. It's like, look, you could talk about a lot of different things. In the day, it's supply and demand, and where you're building a ton of product, it's having an impact. Even on, like you said, your existing site is competing with a brand new one. So hopefully we can continue to get that message across.
Right.
All right. So looking forward, looking ahead, you mentioned rent's pretty flat in most of these markets, a little behind in Austin and Phoenix. When do you think we'll see asking rent growth positive again for the Sunbelt at large? And what markets do you think will get there first?
I mean, I think it's going to happen this year. I think it's by mid-year. I think we'll start seeing some positive rate growth in most of our markets. It really does go back to supply and demand. So the markets I think will see rent growth the quickest or the soonest, maybe Houston, of the markets we're in. There's just simply less supply in Houston. And the demand dynamics, the population migration trends are really similar in all of our markets.
Yeah.
There's not a big difference between the Carolinas and Texas and Phoenix and Florida for us. So I think it really goes back to that supply story. You can almost look at where is supply peaking first. And I think some of these markets have already peaked. Some of these markets are maybe peaking, and you probably know that better than I do, are peaking, right now are pretty soon. And then the markets that have already peaked, I think those are the markets you'll see the rent growth the fastest.
Yeah, no, I agree. I think you're right on Houston. I think it's something under the radar as an under supplied market relative to some of those spots. By the way, though, once all gets knocked for insurance there, when you seen it, is it getting? Are you more optimistic about insurance costs in Houston?
We had a good 2024 insurance year. 2023 was just brutal.
Of course,
it was brutal. It was the value increases that the insurance companies made us do, which probably warranted, and it was also the rate increase.
Yeah,
it was the double whammy there. 2024, we actually saw insurance come in. And hearing different things about 25. I mean, who knows right now with the fires in LA? I mean, that's that can change things quickly. But hearing that it flat to slightly down.
So we're good. Well, that'd be a good sign, especially for places like that and in Florida. So let's talk more about Texas at large. I think there's an interesting dichotomy here, and I've talked about this a little bit in the past, but I want to pick your brain since you're very fluent and invested in Texas. I think we see two things here. We see, number one, a strong, very liquid market for well-located, newer vintage, Class A, B+. Cap rates are sub-5s again, as you know. And on the other side of this, we see some, distress. Maybe it's lowercase d distress at this point, but certainly challenging situations concentrated in older vintages, less desirable submarkets. We have weaker rent collections, heavier capex needs. It seems like every buyer wants that first group of assets right now, and I think that's going to continue to put downward pressure on cap rates to some degree. But that second group, to me, is the real question mark, and there does seem to be some distress there. So my question to you is, how high do cap rates have to get for those assets to get interesting again for buyers like Knightvest and your peers and maybe some institutional groups? And because many of you like Knightvest have moved up market over the years. So as cap rates compressed between asset classes. So I'm curious, is there any going back?
That's a good question. So I'll answer the second question first about, what level of cap rate would it take for Knightvest to go back to the C space? And, so not only did we start on site, we officed on site in Class C properties for the first 4 years of our history. So from 2008 to 2012, we officed on site every day. So for us to go back to the Class C world, it would probably take something that will not get there. Yeah. Meaning so many people will jump in before that's where we want to go. We built the company and our renovation program and our renovation team and our high level of renovations. They really just don't match the Class C world for us specifically. And I think the problem, I think, we talked a little bit about this at lunch, and I'll try not to totally dork out on the numbers, but the problem with the Class C world and why I do think we will see some distress coming up is the going in cap rate. So anything that was bought kind of late 2020 to mid 2022, pretty much any asset class, multifamily specific, but any A, B, or C was bought at a sub 4 cap, all of them. And we bought some too, and we bought them at a sub 4 cap. So we're in the between 3.25 and 3.75. So cap rate. So let's pretend it's a 3.7. Let's pretend it's a 3.5 cap rate. The last few years has been very hard to move the NOIs. So that cap rate and that yield on cost are probably about the same. You've had expense pressure and you've had a hard time moving rents. Most borrowers borrow the floating rate debt at 65% leverage. That interest rate today is about 7 to 7.25. So SOFR right now is 4.25. call your spread, 250 to 300. So let's just say 7.25 is what you're paying. So if you bought a 3.5 cap and your debt is paying in 7.25, you are burning between $750 and $1 million every year in this current interest rate environment. That's how much you're burning.
Yeah.
And so those people that bought in 2021, 2020, 2022, those interest rate caps, even if they bought a 3-year interest rate cap at acquisition, those interest rate caps are expiring, which means they have to buy a new one. And so what's happening, and this is probably a 60 to 70 to $80 million deal. So if you're talking about a $30 million deal, just cut it in half. You're still burning money. That money has to come from somewhere. It either has to come from existing LPs, it has to come from the sponsor, or it has to come from the lender. And I hadn't seen a ton of lenders say, hey, let's cut the interest rates and break even. I hadn't seen that. And so then the money has to either come from existing LPs or the sponsor. And so that's where the distress is even when you hear the story, it's like, well, let's just kick the can down the road. Yeah, you can do that with lenders. But for undercapitalized groups that were getting started and were buying some of these distressed, or Class C deals, there's just a gap of funding. And so eventually the distress is coming. And the question is when. And the other thing that's interesting, when we got started, our first 10 properties were bought from lenders, and we paid between $10,000 and $25,000, maybe $30,000 a door. And I think lenders realize they're not very good at operating apartments. Why would they be? That's not what they do for a living. And so there's going to be some lenders that really want to work with sponsors, but ultimately, where is the sponsor going to get the money? And that's what makes me nervous. So that was a very, very long answer.
No, it's a good answer.
Very, very short question, but
it wasn't a short question, so I'm your offense. Yeah.
But that's where the Class C distress is going to come. It has to come. The question is when.
Yeah. No, and I agree with you, by the way. And I think the other factors too is a lot of these properties, they've only gotten older. They have a lot of deferred maintenance. A lot of the groups haven't been able to put that capital in. A lot of them, where you do have rent collections issues, it tends to be concentrated in Class C. So it's going to take someone with a stomach for some risk.
Right. So groups like Knightvest, we happen to like what a lot of groups do, like what you said, the Class A, minus B plus space that has a value add story, maybe a 10, 15, 20-year-old asset with original interiors. That is a very popular space. That's where we play. We feel like our renovation program is a really high-end renovation that mimics new construction. We think we can buy a property that's 10, 15, 20, 25 years old and really upgrade it to like new. And that's what we do. Unfortunately for us, is a lot of groups like the same thing.
Right.
And so cap rates, mathematically, you look at it and you're like, okay, well, the 10-year treasury is at 4.6, 4.7, whatever it is. How are we buying a 5 cap? And mathematically, you shouldn't, but that's just where it is.
Yeah.
That's just where it is.
Yeah. No, that's the market. So let's go back to distress for a minute and a broader question. How much true distress do you see emerging, and where is it coming?
That's a good question. I think there is going to be, it all depends on the Fed.
Yeah.
If the Fed lowers rates this year, and it could be 2-3 times, I think there'll be much less distress. If the Fed doesn't, if it's truly a higher for longer, I just don't see these LPs putting in money for inexperienced sponsors that bought a lot of the Class C stuff.
Yeah.
And I think you're going to hear a lot of this is throwing good money after bad.
Yep.
I think sponsors are going to go to the lender and say, I don't know what to do.
Yep.
And so I think we're going to see distress. I think we're going to see a lot of distress in DFW. There was a lot of syndicated deals put together with inexperienced sponsors. If you really think about it, from 2010 to 2020, a lot of money was made. There really was. What you had is NOIs were going up while cap rates were coming down. Well, if a lot of money, it's just math. If a lot of money was made in that time, then a lot of money is going to be destroyed when NOIs are not going up and cap rates are going up.
Yeah.
And so I think we're going to see distress. I don't know that we're going to see, I think it's going to be harder to work through. I think there's going to be a lot of quiet distress. I mean, I know that Knightvest this year, we took over 3 distressed GP deals quietly. No one knows about it. It wasn't in the news. And it was existing LPs saying, we're not comfortable with the existing GP. And they called us and said, Knightvest, would you come and take over? And so it's kind of like a friendly takeover.
Yeah.
And so it's stuff like that is happening all over.
Yeah.
And so it may not hit the press. So you may say, where's the distress? Well, we did 3 of those this year.
Yeah. Yeah. No, everyone's looking for, lender taking back the keys. But to your point, we may see less of that on more of other types.
Right. And maybe creative.
Yeah.
And maybe creative.
And the other thing too, I think we'll see a little bit of, and I talked to this a little bit as well, is that there's some groups out there. While most lenders don't want to operate, you have some that have set up, kind of set up credit arms, and they will operate as lenders. Lender and equity with groups have that experience. All right, so let's go back to where you see opportunities. You mentioned what you like, but where do you actually see opportunities as a buyer in 2025 in terms of markets, asset profiles? We've got NMAC coming up in a couple of weeks, annual meeting. That's, the big time everyone gets together, and lots of brokers, I'm sure, want to be getting potential deals in front of you. So what's going to get your attention? Yeah,
I mean, the same thing that so many people like. Everyone likes a story.
Yeah.
Everyone likes a story. So we just bought a deal in Fort Worth. It's not the 3 distressed deals we bought, but we just bought a deal from Fort Worth that sponsor knew that they were basically their equities wiped out. Equity partner said, we're not putting any more money in this deal. Well, the sponsor's like, well, we don't want a foreclosure and we want it to be somewhat quiet.
Yep.
And so we basically paid their debt basis. So they were, they had a 65% loan and they bought at the peak. So we bought basically at their debt basis. So, 65 cents on the dollar, on the peak dollar, out of state operator, out of state equity. So we love those type stories. We like the same story everyone likes. I mean, we want a story where we want to be creative with lenders. We love, we love buying from big institutional groups that don't really focus on the renovation, because we think that's what we do best is the renovation, specifically the interior renovation, which is really hard to do in scale. We spent a lot of time for a long time, a lot of money to really have an institutional quality interior renovation group. As far as markets go, I still think in order for us to go to some of the markets that we think are still going down, the Phoenix and Austin, I think we need something that's pretty discounted.
Yeah. But, so otherwise staying in your existing footprint?
Yeah, so we're planning to stay in our existing footprint. Part of the issue, there's trade-off in however you structure a business. We are vertically integrated, so we have the management company and the construction management company. We have to be careful not growing too far out. We have to go deeper in fewer markets. So our plan for 2025 is really just to continue to be in our markets. At some point in the next couple of years, we'll add a new market, but this year is not the time.
Yeah, makes sense. I want to ask you about a great survey by CRE Daily and John Burns. I've referenced it before in this podcast. But what it shows, and I'll describe it for you briefly, what it shows is the vast majority of GPs plan to be or expect to be net buyers of apartments over the next 6-12 months. But at the same time, the vast majority also say it's much tougher than normal to raise capital. And so the GPs are saying, hey, look, we got rapidly declining supply leading to what could be a multi-year low supply environment combined with strong demand, this massive discount to rent versus own that everybody talks about. But at the same time, and David, you sort of alluded to this about the LPs, is a lot of them still have a lot of capital tied up in current deals that probably aren't performing as well if they're bought in that period you referenced. And many of them, I think, anecdotally, they want to see all the green lights turning on before they jump back in. And so what advice would you give, if any, on how to nudge reluctant LPs off the sidelines in this environment?
It's a good question. As a GP, raising money all day, every day, I'd love to see more LPs jump in. I think 2025, we will see more capital come off the sidelines. It could be, we heard for a long, long time, it's like, we want clarity from the Fed. We want at least to see that, I don't know that we'll ever have clarity, but we certainly saw 3 rate cuts last year. So there were some groups that decided, hey, now may be the time. I personally think and we call it institutional quality deals, I think the bottom has already been hit. That's my personal opinion.
I agree. Yeah.
And so I think the bottom's already been hit. And I think more and more groups are coming off the sidelines. And I think a lot of groups have raised record funds, and there's some pressure to put money out. If you raise multiple billions of dollars, you have to convince yourself that at some point now is the time.
Yeah.
And I think there's going to be more and more groups coming out off the sidelines this year. I just don't know how much product is going to come. I think there's going to be that dynamic of there's going to be, too much money chasing too few deals. And again, talking about the institutional quality deals,
the A, B plus,
the B plus and better. The C space still has a lot of unknowns to me, and has a lot of unknowns. When I talk to capital, there's just a lot of unknowns.
Yeah, in fact, one of the things just on the topic real quick, one of the things I wonder about is, do we start to see more noise in 25 about that Class C stuff that on the macro side kind of makes apartments look more challenged than they really are? Because obviously the groups that are chasing what you're talking about, they know that it's a much different market at an A and B plus.
It's probably the same thing when you read in the Wall Street Journal about real estate. Real estate values are down, and then you dig in it, and a lot of it they're talking about is office.
Yeah. You got to drill down into it.
You got to drill down a little bit.
All right. So, usually I have to make a bunch of predictions. So David, I want you to do that this time. So how do you see 2025 playing out on the capital side? Do we finally see a spike in deal flow that everybody thought we'd see in 2024? Does it happen in 25? And do we see, does actual transaction distress make a bigger splash?
It's a good question. I don't know. I don't think we're going to see, I think we will see more deal flow in 25 than we did in 24. I don't think we're going to see a whatever back to normal is. Yeah. I don't know that we'll see that in 25. The hard thing is it's hard to make deals pencil when your 10-year treasuries of 4.7.
Yeah.
High fours. It makes it harder to pencil. So I think we will see more deal flow. I don't know that it's going to be, a huge amount over the last couple of years. I do believe we will see more and more distress.
Yeah.
I do believe we'll see more and more distress. And I think it just goes back to the math that I said of, if you've got a $40 million deal, you probably have a, $350,000 to $500,000 hole this year to carry it for one more year. If you have an $80 million deal, it could be up to $1 million hole to carry it one more year. And, then if it's a group that's had 5, 6, 7, 8, 9, 10 deals during that time of late 2020 to mid 2022, you extrapolate that out, you're like, oh my gosh, I've got a lot of deals. Which ones can I save? Which ones can I not? Who are my LPs? Are they willing to support the deals or are they not?
Yeah.
And so I do think we're going to see a lot more distress. And we talked about it earlier. I think a lot of the distress may be more creative. It may not hit the news. A lender may come to a Knightvest and say, hey, we've got a package of 5 deals. Would you have any interest in stepping in and doing something creative? For us, that's opportunity. For the existing LPs, that's distress.
Yeah. Yeah. No, that was definitely the big question. I'm curious to kind of get the vibe at NMAC this year too. You're always going to get a good pulse on how everyone's thinking about the year playing out. But it seems like a moderate pickup in sales. It seems to be the mainstream.
Everyone's always excited beginning of the year.
Yeah.
Everyone seems to always be excited. Let's get some deal flow.
Well, and this year everyone's big excited. Hey, look, the supply peak's behind us. It's only sunshine and rainbows.
Well, and everyone said survive to 25, so we're here. Now what?
Yeah, exactly. Well, it does seem like a transitional year in a lot of ways. Moving past the supply peak, moving past the high inflation era and maybe lower rates. So we'll see when maybe we'll be back a year from now and we can evaluate that. All right. So, David, last thing I want to ask you about is you and I are both big fans of apartment life. For me, I think apartment life plays such a big role in turning apartment properties and assets into communities.
You start at the very beginning, you talked about this. These are people's homes. These people live, and people can build friendships and with some of their neighbors. And there's some really good evidence showing, I think it was Witten Advisors did this research showing that when people have friendships in their existing community, they're more likely to renew their lease because it's harder to leave somewhere where you have existing relationships and connections. So I think it's a real win-win. So what impact has apartment life had for Knightvest?
Yeah, it's a great question. So I'm on the board of Apartment Life, so I'm definitely biased.
But a volunteer board member, is that?
Volunteer board, yes. So I think Apartment Life creates community is really the main thing. So from the very, very beginning of Knightvest's journey from 2008, we always had someone that's impacting the community on the property. And maybe it goes back to because we officed on site for 4 years, we saw there's such a need. There really is such a need. And if you think about apartments, and this is just more statistically speaking, so I mean, not trying to pick on apartments, but there's a lot of reasons people live in apartments is because of a life change. You move to a new city, you don't know where to live, you live in an apartment, but you don't have a big support system. You have a life event, whether you lose a job, whether you get divorced, you have a death in the family, you have some financial impact, you move to apartments. There's some loneliness, and they've done studies for this. And so what I think Apartment Life does is they are there, they live on site, and they meet all the residents. They go and knock on the doors for someone that's coming in, just say, hey, we have events. We're trying to gather people around. We're trying to have community. And I think it pays for itself.
Yep.
I really do. I think if because of that community, we can save one or two people that would otherwise have moved, it pays for itself.
Yeah.
And so from a financial side, I believe it pays for itself. I believe it's a net winner. And then from just a community side of just taking care of residents, because ultimately that's what we're trying to do, is take care of residents. So I could go on and on about that. And we have a 501c3 called Knightvest Cares, and we pair that with Apartment Life. So the Apartment Life team generally knows the people's issues, whether, hey, I just lost my job, I had a death in the family, I had a car wreck. I mean, a lot of people who live in apartments, they're one life event away from really having some distress.
Yeah.
And so then we have a formalized process at Knightvest, and then they will turn around, the Apartment Life team will turn around and say, hey, Billy in apartment 202, lost his job and is really struggling. And then if we have a formalized process, then it will go and we, Knightvest, will provide rent relief. And so we've given close to $1 million of practical needs, really mostly in paying for rents. And so we're really proud of that. But really the Apartment Life teams give us that information that then we can then help the residents, get through their life events.
That's great. And I wish more people outside the industry understood that groups like Knightvest and others, thankfully, really do care about the residents. I mean, these are your customers at the end of the day, and they're people. And so, you want to take care of them.
Right.
Well, David, thanks so much for being here. I really enjoyed talking shop with you.
All right. Thanks for having me.
And that's a wrap on episode 17. Big thanks again to David. Thank you to all of you who've listened. And again, if you feel so inclined, would really appreciate if you don't mind ranking, scoring the podcast so we continue to spread the word and hopefully continue to grow our spot in the rankings. Thanks again. Have a great week.